Are you one of the millions of people who have been led to believe that buying a house is the ultimate symbol of financial success, a milestone that marks your transition from renting to owning, from being a tenant to being a homeowner? But what if I told you that this notion is nothing more than a cleverly crafted illusion, a myth that has been perpetuated by the real estate industry and reinforced by societal pressure? The truth is, buying a house is not always the best financial decision, and in many cases, it can be a recipe for disaster. In fact, a study conducted by Dr. Robert Shiller, a renowned economist from Yale University, found that the average return on investment for housing in the United States over the past 100 years is a mere 1% per year, which is lower than the rate of inflation. This means that if you had invested your money in a savings account or a low-risk investment, you would have been better off in the long run. But that's not all. The myth of homeownership as a sound investment is not just limited to the United States. A study published in the Journal of Economic Psychology by Dr. Uri Gnezy, a behavioral economist from the University of California, San Diego, found that people tend to overestimate the value of their homes by as much as 20%. This is known as the endowment effect, a cognitive bias that causes people to assign a higher value to things they own simply because they own them. In other words, just because you own a house, you tend to think it's worth more than it actually is. And this bias can lead to some pretty disastrous financial decisions, such as taking out a large mortgage to buy a house that may not even be worth the amount you're paying for it. According to a study by Dr. Michael Seiler, a real estate economist from Old Dominion University, the average homeowner in the United States spends around 30% of their income on housing costs, which is a significant chunk of their budget. And when you factor in other expenses such as maintenance, repairs, and property taxes, the true cost of homeownership can be staggering. So, the next time someone tells you that buying a house is a great investment, you might want to think twice. The idea that buying a house is a sound investment is deeply ingrained in our culture, and it's often perpetuated by well-meaning but misinformed friends and family members. But the truth is, the housing market is highly unpredictable, and there are many factors that can affect the value of your home, from changes in the local economy to shifts in government policies. And let's not forget about the opportunity cost of tying up a large chunk of your money in a single asset, such as a house. When you put all your eggs in one basket, you're essentially putting all your financial eggs at risk, which can be a recipe for disaster. In fact, a study by Dr. David Blanchett, a financial planner from Morningstar, found that the average homeowner in the United States has around 60% of their net worth tied up in their primary residence. This means that if the housing market were to crash, as it did in 2008, many homeowners could find themselves facing financial ruin. The myth of homeownership as a sound investment is also perpetuated by the real estate industry, which has a vested interest in convincing people to buy houses. Realtors, mortgage brokers, and other industry professionals often use high-pressure sales tactics to convince people to buy homes, even if it's not in their best financial interest. And let's not forget about the emotional appeal of homeownership, which can be a powerful motivator for many people. The idea of owning a home and putting down roots in a community can be very appealing, especially for people who are looking to start a family or settle down. But the truth is, there are many other ways to achieve these goals without breaking the bank or taking on a large amount of debt. For example, you could consider renting a home in a desirable neighborhood, which would give you the same benefits of homeownership without the financial risks. The financial risks of homeownership are very real, and they can be devastating. When you take out a mortgage to buy a house, you're essentially taking on a large amount of debt, which can be a significant burden on your finances. And if you're not careful, you can end up paying thousands of dollars in interest over the life of the loan, which can add up quickly. In fact, a study by Dr. Jack Guttentag, a mortgage expert from the University of Pennsylvania, found that the average homeowner in the United States pays around $100,000 in interest over the life of a 30-year mortgage. This is a staggering amount of money, and it's something that you should carefully consider before taking out a mortgage. And let's not forget about the other expenses associated with homeownership, such as maintenance, repairs, and property taxes, which can add up quickly and eat into your budget. As we've seen, the idea that buying a house is a sound investment is not always supported by the facts. In fact, there are many cases where renting a home can be a better financial decision, especially for people who are not planning to stay in one place for an extended period of time. For example, if you're a young professional who is just starting out in your career, you may not know where you'll be living in 5 years, let alone 10 or 20 years. In this case, renting a home can be a much more flexible and affordable option, as it allows you to move more easily and without the burden of a large mortgage. And let's not forget about the benefits of renting, such as not having to worry about maintenance and repairs, which can be a significant cost savings. According to a study by Dr. Christopher Mayer, a real estate economist from Columbia University, the average renter in the United States spends around 30% less on housing costs than the average homeowner, which is a significant difference. So, if you're considering buying a house, you might want to think twice and consider the alternatives, such as renting a home or exploring other investment options. And as we'll explore in more detail in the second half of this video, the benefits of renting can be significant, especially for people who are looking to save money and achieve financial freedom, which is something that we'll be discussing in more detail as we delve deeper into the dark truth about mortgages and the myth of homeownership as a sound investment, and how it can impact your financial future, and whether or not it's really worth it to take on the risks and responsibilities of homeownership. As we've established, the idea that buying a house is always the best financial decision is a myth that's been perpetuated for far too long. In reality, the costs associated with homeownership can be overwhelming, and the returns on investment are often lower than expected. According to a study published in the Journal of Financial Economics, researcher David H. Downs found that the average homeowner spends around 30% of their income on housing costs, which can leave little room for other expenses, savings, and investments. This is particularly concerning when you consider that many experts recommend spending no more than 25% of your income on housing. But what about the argument that buying a house is a good investment because it will appreciate in value over time? Well, it's not that simple. While it's true that real estate values can increase, they can also decrease, and there are many factors that can affect the value of a property, such as location, condition, and market trends. In fact, a study by researcher William N. Getzman found that the average annual return on investment for real estate is around 3 to 4%, which is lower than the average annual return on investment for the stock market. And let's not forget that with investing in the stock market, you can diversify your portfolio and spread out your risk, which is much harder to do with real estate. So, what can you do instead of buying a house? Well, for starters, you could consider renting and using the money you would have spent on a down payment and mortgage payments to invest in other assets, such as stocks or bonds. This can be a great way to build wealth over time, and it's often a more liquid investment than real estate, which means you can access your money more easily if you need it. For example, let's say you were planning to buy a $200,000 house with a 20% down payment, which would be $40,000. Instead, you could put that $40,000 into a diversified stock portfolio, which could potentially earn you a higher return on investment over time. Another option is to explore alternative forms of homeownership, such as community land trusts or cooperative housing. These models allow you to own a home without shouldering the entire cost of the mortgage and maintenance, which can be a more affordable and sustainable option for many people. For instance, a community land trust might allow you to buy a house for $150,000, but you would only be responsible for paying a portion of the mortgage, with the rest being subsidized by the trust. This can be a great way to get into homeownership without breaking the bank. In terms of practical steps you can take today, I would recommend starting by taking a close look at your budget and seeing how much you can realistically afford to spend on housing. Make sure to factor in all the costs associated with homeownership, including mortgage payments, property taxes, insurance, and maintenance. You should also consider exploring alternative investment options, such as a high-yield savings account or a low-cost index fund. And if you're already a homeowner, consider ways to reduce your housing costs, such as refinancing your mortgage or negotiating a lower interest rate with your lender. For example, let's say you're currently paying 4% interest on your mortgage, but you could refinance to a 3.5% interest rate. This might not seem like a huge difference, but over the life of the loan, it could save you thousands of dollars in interest payments. And if you're a renter, consider negotiating with your landlord to see if you can get a lower rent or better lease terms. You might be surprised at how willing they are to work with you, especially if you're a good tenant. It's also important to remember that homeownership is not the only path to financial stability and security. In fact, many people find that renting and investing in other assets is a more effective way to build wealth over time. So, don't feel pressured to buy a house just because it's what's expected of you. Take the time to do your research, crunch the numbers, and consider what's best for your individual financial situation. And remember, it's okay to prioritize other financial goals, such as paying off debt or building an emergency fund, over buying a house. In fact, a study by researcher Daniel Kahneman found that people tend to overvalue the importance of homeownership and undervalue the importance of other financial goals, such as retirement savings or paying off debt. This can lead to a phenomenon known as loss aversion, where people are more motivated by the fear of losing something they already have than by the potential gain of something new. So, be careful not to fall into this trap and make sure you're prioritizing your financial goals based on what's really important to you. For instance, let's say you're trying to decide whether to buy a house or pay off your student loans. While buying a house might seem like a more exciting and tangible goal, it's likely that paying off your student loans will have a more significant impact on your long-term financial stability. By prioritizing your debt repayment, you can free up more money in your budget to invest in other assets or pursue other financial goals. Ultimately, the key to making smart financial decisions is to approach them with a clear and rational mindset, rather than getting caught up in emotions or societal expectations. So, take a step back, do your research, and consider what's best for your individual financial situation. And remember, there's no one-size-fits-all solution when it comes to money. What works for someone else might not work for you. In conclusion, buying a house is not always the best financial decision, and it's essential to approach this decision with caution and careful consideration. By understanding the costs and benefits of homeownership, exploring alternative investment options, and prioritizing your financial goals, you can make a more informed decision that's right for you. If this helped you think about money differently, subscribe. I post new finance insights every single day. And if you want to go even deeper, check the link in the description for Rich Dad, Poor Dad by Robert Kiyosaki. It changed how millions of people think and act.